Welcome to Monday Mondays,
I was
everybody.
counting down from 5, dude. I was counting down from 5, all right?
Well, you got to get, your daughter, I don't know if you want me to say her name, but get her up here. She can kind of do the countdown for us.
She might have better luck than I do. Sometimes once you get past 4, man, it's all bets off,
Yeah.
So,
but welcome to Monday Mondays, everybody.
Money Mondays, Disrupt TV. Ben, Ferris are your hosts. And what are we talking about today, man?
We are talking about how people can get started in multifamily investing, right? As a multifamily investor. So, just kind of the ins and outs, what it takes, some things to consider, right? I know a lot of people came from residential, including myself, right? And really talking through how that compares. And so, that's probably our topic today. So for those of you that don't know, our Money Mondays, every Monday at 3:30 Central, right? We will go through all sorts of different topics. Usually we have one key thing that we're presenting, but again, we're happy to talk about other things people want to talk about. So you're welcome to ask questions. We will go through those live here, Q&A. And feel free to let us know what you guys want to know, what things are interesting, what's going on in your world. We're happy to talk through them.
Yeah, I mean, we're coming up with a lot of these on our own in terms of the topics.
I like
but
to
we
say
do
we
want it
like
to be,
to wing it.
Yeah, we do want it to, we want it to be interactive, folks, right? So, I mean, and we've told you guys this in the past, right? It doesn't have to be multifamily, it doesn't even have to be real estate related, right? We could talk about being an entrepreneur, being a business owner, tips and tricks to, be a better business owner, right?
More importantly, I thought about this today whenever I put the shirt on. Ronnie just said he didn't get the memo about plaid. So how's it going, Ronnie? Long time no see.
It's funny, man. Like every time on Monday mornings, I'm like,
Ronnie has me nervous whenever I wear plaid shirts.
Should I wear a plaid this morning? And then I think, no, Ronnie would not like that.
Would not approve.
So, yeah, he would not approve. So, no, man. So how's it going, buddy? Thanks for always tuning in, man.
Yeah.
But all right, so let's kick this thing off, man. So we have a couple questions here. What makes multifamily investing, I guess, so popular? I mean, lucrative, whatever you'd like to call it, right? It seems to be one of those things that's, even through COVID, it has still been very, very popular. Right?
Yeah, well, I think it's getting more popular. I have a theory that I think in the long run, multifamily cap rates will compress, right? It's a reminder to everybody that, hey,
so what does that mean? Resilient. Let's step back. You're throwing some terminology around.
Basically, things are going to get more valued because there's going to be a lot more interest. Let's keep it dead simple.
Well, or things might be getting, you look at the flip side, right? Things are going to get more expensive.
No, by more valuable, I meant more expensive, I guess.
Gotcha,
So there's going to be more demand, therefore people that currently own it, it's going to increase in value because it's getting more expensive.
So if you bought 5 years ago, you're probably sitting pretty.
Absolutely.
But that doesn't mean that you still can't find deals. We're making offers. There's still stuff out there. So you just have to buy at the right cap rate for that area and make sure that your rent supports that.
Yeah, no, absolutely. So, it's a good place to be, and I think we're going to see where the next 6 months go, right? We'll start to see if some of these multifamily deals, don't perform as well as they used to, right? And maybe we can pick up some deals cheap, or maybe they continue to. So we'll see what happens with the government.
You just never know, right? I think, it was one of those things, if you would have asked me the same question back in April, I probably would have had a little bit more of a bearish look on the whole market. But, once again, multifamily, and this is one of the reasons why me and Ferris got into multifamily, is because it is so resilient, right? It's, we are providing housing to a very, very big sector of the United States, right?
Yeah.
And our biggest partner is the federal government. It's in their best interest to make sure that these perform, that people can pay their rent, and that these properties provide affordable, clean, quality housing, right?
Yeah.
And that's how we serve the market.
Absolutely. So, but let's rewind a little bit. So let's talk about, do you like multifamily, Ben?
I do like multifamily.
All right, good, because that was probably the only answer you could give. But no, we love multifamily, but I'll tell you guys why, right? I think on our slides, one of the questions is what makes multifamily investing so lucrative, and I'm going to answer it is, I came from a software background. I like things that scale, and what I like about multifamily is that it does scale.
Yes.
Right? Came from the residential side. My very first purchase was a fourplex. It's about a mile down the road from the office, and I got a taste of it, but then I bought a bunch of houses. Realized it does not scale very well, right? You end up having 12 loans, 12 insurance policies, 12 everything, right? And it kind of sucks. So multifamily is complete opposite, right? Especially if you're in syndication. Syndication is very much a scalable type business if you can run a business appropriately. And so, I think, that's what attracted me to multifamily. And really the biggest thing to me is just around how you can do forced appreciation. That's what made it more lucrative for me, is that
I like that too.
I can't make a house in the neighborhood be worth more than the other houses, right? Even if I put $1 million into that house, I probably am not going to get close to $1 million.
Because it's all driven by comps, right? Sales comps, right?
Absolutely.
That's probably, let's step back, let's talk about that, right? Because I think that this is one of the biggest differentiators, I say, from single family to multifamily, right? So what is forced appreciation?
Forced appreciation. So let's go back, I guess, to cap rate. Somehow we keep talking about cap rate. For those who don't know, what is a cap rate? A cap rate essentially is a way to identify a property's value relative to other properties, right? Like Ben said, in a neighborhood, you have comps. Comps are attractive because you can say what the house next door and the house the street over, what those are worth, because they're all generally very similar. Well, in the commercial world, you don't have as many comps nearby to compare against. So instead, cap rate is how they look at it, right? This is a 5 cap area, this is a 6 cap. And really all it means, if you bought the property cash and did nothing different than what the previous owner is doing, right, how much could you get return on your cash? And so if you're buying a deal that's a 5 cap, right, if I bought it cash, again, I'm taking leverage and the benefits of leverage out of the equation. I bought it cash, and I'm not going to do anything special. I'm going to operate it just as effectively or ineffectively as the current owner, right? What would I get return-wise? That's what a cap is. Now with multifamily, right, the cap rate the equation for cap rate, it's NOI over value equals your cap. So if you're in an area that's a 5 cap, 5 is a fixed number, it's not changing, right? Now your NOI is what you can change, right? I can do things to improve my NOI. I can make interior upgrades.
Operating income, right?
Net operating income. I can, update the interiors. I can install carports. Things are going to boost my income. Well, if I boost my income, then my value X, what I'm solving for, actually goes up, right? And so that's the theoretical value of the property. So you can do those kind of things in multifamily. And to me, that was the gravy. I'm like, okay, I can actually control that, whereas I can't control comps.
Controllability, scalability, right? Some of the other things that we really love about it, and this was something that really wasn't talked about when we first got into the business, but now over the last few years is becoming very, very important, to make a lot of these deals work, right? Is depreciation, right? And so essentially what it is, and some of the cost sag has already been around, it's been around for years. What's happened through some of these acts, the Jobs Acts or whatever, right, is they've introduced stuff that makes cost segregation even better, right? It makes it bigger. It maybe you are able to pull some things ahead, in the first year or two versus having to wait over a course of, say 5 to 10, so you've got bonus depreciation now, right? So those things, come along to a partner in the deal on your K1 as a paper loss, right? So you could be profitable, but on paper it looks like you're losing money because of this depreciation component, right? So therefore all that flows down to your personal tax return, and that's going to offset some of your passive income if you have other passive income, or if you're a real estate professional, some of your active income too, right? Check with your CPA. We're not CPAs. There's a lot of things that go into this, right?
Yeah, you don't want Ben to be your CPA.
You don't want me to be a CPA, right? We pay good money to good people to do that for us, right? But bottom line, it starts becoming very, very powerful. And so depreciation is another reason why we think multifamily is one of the most lucrative asset classes to be in, right? So let's talk about roles, man. If somebody's trying to get into, multifamily, trying to be a syndicator or trying to add value to a group that's doing deals, what are some of the roles that they can add?
Before we talk about roles, let's quickly update people. So, everyone, you're watching Money Mondays. We do it every Monday, 3:30 Central, right? And the goal, really, we're talking about different topics. Today, we're talking about
getting into multifamily and just the beginning parts of the multifamily investing, right?
At the end of it, we'd like to do open Q&A. So you guys are welcome to leave comments, questions, and we will go through them live. I know we have one coming up. I'll answer this one right now. Savion, how's it going again? Nice time to see. All
right.
But he's asking, how many projects would you say you guys aim to do per year? I'd say in terms of acquisitions, 4 to 8.
Yeah, somewhere in that range is what we're trying to, right? Ultimately, this year, because of COVID, we're probably not going to hit that goal, but
two's my number for the
if we could do 2, we'll be happy campers, right?
Yeah, all right. So keep going. So roles you can play in multifamily. So the first and foremost, and the way most people get started, passive investor. Right? Go find deals to invest in. And it's not hard. You can meet people at conferences, events, referrals, friends, and finding deals that are attractive and learning, does that operator, does he have a track record or not? But can he get you the results of what you're looking for? And does his criteria match your criteria?
It's all about risk tolerance, right? So, you've got to find the deals that you want to invest in based on your risk tolerance, right? So some people, for example, might say, hey, I don't need cash flow right now, so I'll invest in that development deal, and get that big payoff in 3 to 5 years, right? Whereas there's other investors that we have that say, hey, I need cash flow pretty quickly because that's essentially what I'm living
retired,
off of.
Yeah,
I'm already retired. That's what I'm living off of, right? And so, certain deals might not work for that. So you need to determine what your box is, right? And then you need to go find people that are playing there and providing you deal flow that fits in that box, right? But what's a progression? There's a natural progression that I see, right? So you go from passive investor to what?
And then from that, really, you figure out a way to participate in a GP in some limited capacity. You can find a deal. You can help operate a deal. You can help, basically, so source the deal or equity kind of go together, right? Operate the deal, helping
be a
figure
KP.
out, be a KP, right? Signing on a deal. Provide liquidity, provide the balance sheet, right? Maybe you're really good at construction, helping manage the construction rehab project. So it's really find a way to add value to an operator that you know. That's probably the next most common way. And then from that, right, well, now you've kind of got, because there's I like to say syndication is not hard, but it's very much project management on steroids. There's a lot of pieces that are moving at the same time, right? Trying to do it on your own, you can do it. Obviously people have done it, we've done it. But it's partnering with people that have also done it makes things a lot easier. Yeah,
you got to find out what you like to do, right? Because some folks, it's funny, they'll get into being on the GP or on the syndication side, and they'll find out, hey, I don't really like doing whatever, asset management or construction management or something, right? And so now they know, like, hey, on the next one, I'm not, if I can't, add value for the things that I like to do, then I'm gonna have to find a group that I can, right? But then sometimes there's a progression even beyond that point, right? And that's where you can be a lead sponsor or a lead syndicator, right? And those are the people that are usually putting the whole thing together, right? You're putting the team together. You're probably ultimately asset managing / property managing the deal. You're probably doing the bulk of pretty much everything. And so, that's the natural progression if you want to go down that route. But realize, people, that this is an actual business, right? Once you get to that point, it's no longer a side hustle. It's not something that you can just, do whenever you feel, oh, I want to do some syndication today. It doesn't work like that. It turns into a real job, a real business that you have to grow.
It's not so maintain. Passive. It's not so passive on the active side.
No, it's absolutely an active thing that you're going to be living, breathing, and eating, until you sell that deal or those deals, right?
But we do have a cheat sheet to help you.
Yeah,
right?
we do. We do.
DisruptEquity.com/MF cheat sheet. If you we put together a cheat sheet just on some things to think about, right, as you're getting into the business. So definitely go to the website, go check that out. You can go download that today. But
So, how do people get started, right? We talked about this a little bit, but let's just say, what's the easiest path, if you, besides being a passive investor, because I think everybody realizes that, right? But what's the one thing that, people can do? I always say, go find yourself a deal.
That's what I was,
that's probably the easiest thing.
If you have a real deal, trust me, there's a ton of people that will partner with you on that.
Yeah.
Right? If you have a real deal, come talk to us. We're happy to take a look. Anyone out there that has a real deal, anything from 100 to 400 units, most markets in the country, we're happy to take a look, right? If it's a real deal.
Yeah, because I always say that there's two sides of the coin, right? You can find the deal, you can find the money. Finding the money is a little bit tougher, right? Because you really either have to be piped into a group that has wealthy individuals within it, and you have already built that trust for whatever reason, or you have to have a track record, right? But whereas you can still get yourself a deal and get into a deal, right? Without having the access to the equity. And so I'd say that's always the best way to get started, right?
Oh, for sure.
If you're trying to get into multifamily, go bird dog yourself a deal. That's probably the best way to do it, right? Yeah. So we got some open Q&A.
Yeah, so I had a few questions come in from online. So if you guys have questions, definitely feel free to chime in. But before we go to Q&A, right, watching Multifamily Mondays. We do this every Monday, 3:30 Central. Today we're talking about getting into multifamily investing, what that looks like. But again, you're welcome to ask questions about anything. We're open books, transparent. We're happy to talk about things that people want to talk about. So if you have questions, go ahead and leave them. And the first one is bonus depreciation. Maybe you want to mention what bonus depreciation has been. Yeah,
we talked. I hinted at it earlier, right? It's something that's fairly new because of the Jobs Act, but essentially it allows you to pretty much supercharge cost seg, right? So cost segregation allows you to kind of come in and say, all right, on this building, this thing is going to, its useful life is, so many, 27 and a half years, right? And you're 5 years into it, there's a certain amount of depreciation that you can take for that item, right? Especially when you come in.
Yeah, like in real estate, the average, real estate, if let's say you buy a house, right? You get to depreciate that over 27 and a half years. Well, guess what? That stove is not going to last 27 and a half years, right? So with cost segregation, they're going in, they're saying, okay, all the stoves in this building are worth X. These depreciate over 5 years, so we can kind of get it accelerated, right? That's what we call accelerated depreciation, right? That's why you're doing the cost segregation study. Bonus depreciation is what came out of the Jobs Act, where you can say, on top of that, I want to go, accelerate even more of what I could typically do. Yeah,
instead of, say, 5 years, you might be able to do it in 1 or 2, right? Yeah. So that first year or two, folks, you can really juice the benefit of a cost segregation study, right? And Madison Specs is the company that we use. They're good guys. Yeah. So you should check them out. They can answer any questions that you need about that type of stuff. Because it is kind of evolving, right? Some of this stuff's a little bit newer, but it's pretty powerful.
Yeah, so another question from Savion. Question, from my understanding, you shouldn't be communicating with potential investors without a PPM drafted. Can you hire a securities attorney to just draft the document so that you have something tangible to use to refer to in order to address concerns of a potential investor? Yeah, you can have someone draft what your potential PPM will look like, right? I think you just have to be careful probably how you talk about it. That's probably a question better for a securities attorney than us.
Yeah,
if you need referrals, reach out to us. We're happy to kind of point you at a few of them. But I think it's like, you can say, here's what my PPM will look like whenever I have a deal. I don't have a deal yet, but here's what I will have in it, and the returns are dependent to that deal.
And really, there's nothing wrong with having a simple conversation, right? Say, hey, I'm looking at deals, and I'll just throw, I'm looking at deals that are 100 units and above in Houston that were built between 1970 and 1990, right? The returns could be anywhere from 8 to 12% cash on cash, blah, 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 blah. Right? You can talk in hypotheticals. Nobody's going to get in trouble talking about that, right? And if I have this deal, Mr. Investor, can I come talk to you about it? There's nothing wrong with that, right? I don't think you need a PPM to do that, have that conversation. Now, you obviously, if you're going to start raising real money, you need to have a real deal and you need to have a PPM, right? Don't take $1 without that subscription agreement and that PPM in hand, right? Because you can get in a lot of trouble.
Yep.
So,
if you keep it below that dollar threshold, it should be. They're saying it should be okay.
99 cents. I don't know. Go talk to the SEC about that one, but you get what I'm talking about. Yeah. It's better to err on the side of caution, folks. When you're talking about this, you don't want to end up on the front page.
9 o'clock news. Come on, newspapers are dated. All right, now we're just TV.
All right, man. Well, I lost my hair. I'm obviously old, so But all right. So tips on taking down your first deal as a multifamily syndicator, right?
Man, that's a loaded question.
That is a very loaded question.
I guess if you're doing it all by yourself, right? Let's say you are the chief syndicator. Tip is stay organized and have people out also can help steer you in the right direction, right? There's a lot of moving pieces, right? We do have a whole course on this on our Investor Academy, so investoracademy.net. If you're interested, we do a deep dive and really talk through what are the 20 different moving parts of syndication and closing process to help make sure people, avoid those mistakes. So definitely highly recommend you guys check that out. Investoracademy.net is the website.
Yeah, and reach out to us. We got coupon code. We want people to do the business right, and that's where a lot of this educational piece is going to be. Because that is a loaded. There's a ton of things that you have to be careful about.
Yeah, so really the tip is just don't screw it up. Be careful. Make sure your deal is going to perform right, especially if it's the first one. Your best investors are investors that continue to invest with you, right? Ben and I did an exercise where we were kind of going through investors, and one investor referred 13 other people, right? Yep. And so that's powerful, right? Yep. And so do good to your investors, even if you have to give up your share of the deal, right? If you need to make sure they're whole. So I think really that's my tip is, it's other people's money, take care of their money better than you take care of it yourself.
Yeah. Look at it through the lens of, you do not want to lose people's money. Right. The secondary to that is making people money, right? But you talk to a lot of these high net worth and ultra high net worth individuals, right? It's all about preservation of capital, right? And obviously probably tax benefits when we're talking about commercial real estate, right? If they end up making, 8 to 10% cash on cash, great, right? But they do not want to lose a penny of that money. So be very, very careful, double check all your numbers, and also rely on a good team, right? As Ferris had mentioned earlier, there's people that are trying to shepherd the deal towards closing, and they'll make sure you stay out of trouble so it actually gets to closing, and then make sure that you have a good property management company and a good asset management on the back end to make sure that you can hit that business, those business objectives, right? Because otherwise, it's all just projections. So those would be my tips, is to make sure that your team is set in place and they are good and they are solid, right?
Yeah.
All right, so next question. How to find investment opportunities as a passive investor?
All right, that's a good question because it kind of ties to this. So as a passive investor, right, go to events, go to different Facebook groups, right? Go to Multifamily Masters, right? That's a good group. You can kind of see there's a lot of them, right? I know John has Texas Multifamily Investor Network, very good group as well, right? Search online, ask for referrals, ask us. We'll give you a list of 10 other guys that we know, right? We're happy to kind of, point you at people and ultimately to figuring out, can you find a sponsor that can perform? Can you find a sponsor that has a similar investment criteria to what you're looking for?
Yeah, like we talked about earlier, right? Are the deals that they're doing in your box, right? But one thing to kind of take into consideration, right? Passive investors, it's a truly passive thing, right? Our expectation from our passive investors is you fill out 4 pieces of paperwork and you make your wire transfer in, right? And then we hope that you're reviewing our monthly financials. Some people do, some people don't. But that's essentially all you have to do. Right? So, if you're wanting to take a more active role, right, then you need to start looking into how do you add value to somebody that's doing deals. That's what we talked about earlier, right? But how to find investment opportunities, you got to network. You got to put yourself out there. And that's really at first, and a lot of people are like, I don't really like to network, and we're in COVID and we get all that, right? But if you're really serious, you have to find the people. These things are very tight knit. There's 20 or 30 investors tops on a lot of these deals. So if you want to be one of those 20 or 30 people that gets in on these opportunities, then you got to go seek out those people that are doing deals, right?
Absolutely. All right, so you're watching Money Mondays, right? We do every Monday, 3:30 Central.
Yep.
We're talking about multifamily investing and kind of how to get into it, but we're happy to talk about anything. So if you have any questions, Q&A, feel free to leave them. I know we have another question that came in. What's the best way to locate property owners, say in Washington, D.C. or multifamily buildings?
Okay.
So I think the answer to that is 99% of actual larger multifamily comes through a broker one way or another, right? That's money that is well spent, meaning, don't try to save a buck, right? Cut them out of it. You actually work with them, right? They're really good at knowing all the sellers. And so I think that's my first piece of advice. Second piece of advice, CoStar has a lot of this data, right? We do have a CoStar subscription, that's not free, so you have to kind of figure out a way to get access to that data. CoStar does have it, and there's some other services that can help with that. It's ultimately about what size property you're looking for. I'd say if you're looking for, and we're talking about anything that's probably, I guess if you're looking in DC, anything 60 units and up, right? You're probably going to go through a broker one way or another. Now, if you're looking at smaller multifamily, check your county records, right? People do this a lot today with houses, right? Skip tracing and kind of all of that stuff. So you can leverage some of that stuff for the multifamily world. It just doesn't, it kind of starts to not be so effective as you get bigger.
Yeah, no, I agree, right? There's things, especially if you're talking about smaller multifamily, a lot of the stuff that you might be potentially doing on single family might work, right? Letters, we know Juan Vargas is a great example. He's got a great story where him and his wife were sending out these letters, man, and they're locked up, I think, a 30 unit.
Yeah.
Here in the Houston area. So that stuff works sometimes. As Ferris said, there's kind of probably diminishing returns as you get higher and higher, right? And so work with the broker, because sometimes you'll find brokers that will be your buyer's broker too, right? They'll go out and they'll find deals for you, right? But you're going to have to ultimately pay their fee. But who cares if the deal still works? Then what's the big deal, right? It's worth it to pay that 1% to 3%, right? So, but that was a good question though.
Yeah. So, if anyone has any more questions, feel free to go ahead and ask them, right? Money Mondays, every Monday, 3:30 Central. We go through, we're talking about multifamily investing, but we're happy to talk about any questions people may have. So feel free to ask questions if you have them. Also, we put together a cheat sheet for this, so check out disruptequity.com/MF cheat sheet to check out kind of our cheat sheet and some tips and tricks and things to kind of think about as you're going through it. But if anyone has any more questions, we're happy to talk through them. Otherwise, we can talk about, Ben's shirt. I really like the shirt. Right? Disrupt Equity.
The namesake here.
Like the name. All right, we did get another question.
All right, what do we got?
Actually, we got 2 more questions, but I'm gonna answer the more important one first. Sorry, no offense, Avion. Ronnie asks, how many times do y'all go to Starbucks a week?
At least 5, dude.
At least, yeah. Then I'm usually stop by Starbucks in the morning, so I guess we do both have Starbucks cups.
Yeah, probably.
Starbucks is not a paid sponsor yet. But at some point,
he's actually the problem. I used to not drink as much Starbucks before.
We did expand the office, and now we have a sink, and we will have an actual machine, so it'll cut back on the Starbucks. problem.
I don't know, maybe a little bit.
No, it'll
Save us a couple comments.
Yeah. So now let's go back to the other question that we got. So you would suggest using stuff like list source, et cetera, to pull lists of owners on smaller properties, but the bigger properties brokers are more than likely going to control those properties. Yes, that's exactly it, right?
Yeah.
Smaller stuff, list source, your county records, even just finding random nuggets on your real estate agent websites, right? Houston, it's hard.
LoopNet.
You can find some smaller stuff on LoopNet too. So, you're gonna have to mine some of that, right? You're just kind of sifting through the bad to find the good.
MLS.
Yeah.
I've seen stuff up to 20 units.
That's what I was trying to say with MLS is the word I was looking for. That's where you can find, some of the smaller stuff. And again, it's about finding the situation where the wrong agent was listing that, right?
Those are the
person that doesn't know how to list a 5 unit. Like, for example, someone that is looking at a 4-plex and listing it as, okay, well, I know in this area price per square foot's $100, and so I'm going to list it like a house, but it's actually 4 units, and you have to count for that too. So finding those situations is where you can make some money.
That is where you can make a lot of money. You always want the wrong broker on the right deal.
Yeah.
Right. Ask us how we know.
Absolutely. But if anyone has any more questions, feel free to drop them. Otherwise, we're going to wrap it up here in another minute. So.
All right.
Any more questions?
Going once.
We'll give them another 10 seconds.
10
seconds? I feel like we have maybe a 5-second delay on the video feed. But if anyone has more questions, go ahead and drop them. We're happy to talk about anything,
check out
including our
folks.
Starbucks as well.
We'll talk about the Starbucks and how I lost my hair.
You don't want to know how Ben lost his hair.
No, you don't want to know.
That's a long story. It's a long story.
It's multifamily
I still hear it
related.
till this day.
It's multifamily related, right? But yeah, check out that cheat sheet, folks. That gives you a little bit more information. And like Ferris had mentioned, on Investor Academy, we really take a deep dive on all this stuff, from passive investing to being a sponsor to underwriting a deal, right? So check that out as well.
But I guess if no one else has any more questions, we'll go ahead and call it a wrap then.
All right. Signing off from
Thank you
Disrupt
guys.
TV Studios.
See you guys next Monday.